Got to start somewhere.
That's why this is going to be a great one. This podcast will be so good.
This is like 101 stuff.
Yeah, we get asked a lot about some of these different avenues. I ask myself about them a lot. Like, what are they again? No, I'm just kidding. I know what they are.
Hey,
I ask Gemini all the time. Yo.
It's a lifelong process.
I got to take that photo so I can post and tag us.
Oh, there you go.
You know what I mean?
Yeah.
I'm so glad you're active on social because I'm not. I can't remember the last time I posted.
You know what it is? Social, it can turn into, it can like consume you. It's a never-ending monster.
Yeah, I've got people in my life who are like, that's their livelihood is being influencers, and it's every moment of every day is like, how can I turn this into content?
I've seen some of my buddies like crack, like fall apart.
You reach a point. I would get so tired.
Oh yeah.
Like, it's got to be so draining. And you see people go through that until they crack, and then they're just like, I'm done.
Yeah, and they move on. It is a good tool though. If I am on there, I try to follow like stuff like this. I'm gonna get educated on real estate. Like most of my feed is like either real estate, private equity, venture,
Really?
the stock market.
Mine is not.
Like, mine is just straight up business and sports.
How's that algorithm generated? Because right now mine's birds.
That's okay.
Like
Birds?
like parrots talking, trying to fight with their owners. Like birds doing like just random stuff, talking or like mimicking the sound of a zipper or Velcro. Or like this guy, he like scratched the table with a pen, and the bird walks up and like slams its head on the ground and is just like
Doing the same thing.
Yeah. So if you guys want some crazy bird videos, let me know. I'll send them.
Forward them on.
I do have a what do you call it, like a playlist for kids. All the videos that I want to show my kids, like I'll see them like, oh, I want to show them that later, and they're usually around animals, like a clouded leopard, like tackling a mountain goat and falling 500 feet.
I saw that one.
Yeah.
Like, oh my gosh, my son's gonna love this video.
Love it.
Or there's this one, it's something wildlife or something like that with Garrett. He's just like goes off into the Amazon or in the Florida Everglades, and it's just he picks up animals and gets up real close to crocodiles and then pythons and
Oh man.
it's wild. So I get those videos and my kids just eat them up. They absolutely love these videos. So my feed is full of also animals, but it's usually within that vein.
I remember watching the old nature videos growing up
Nat Geo.
on like, Nat Geo or PBS.
Yeah, PBS.
Channel 7.
Nat Geo, that sounds like cable.
Yeah.
I had like 5 channels.
As a kid, same.
PBS was one of them.
Oh yeah.
PBS was one.
Yep.
Yeah.
The state.
Channel
yeah.
7 or Channel 11.
That's right.
Yeah. Oh, yeah. Should we get this thing rolling?
Let's roll.
Get it rolling along. What's up, everybody? This is the HIG Podcast. I'm MattyP, and I'm here with your host, Bronson Kaufusi.
Hey, everybody, what's going on?
What's up, Bronson?
How we doing, everybody?
And special guest, we have Jesse Yeats.
Hello, hello.
We're here to talk about some of the common terms that we face. We get asked here working at Harris Investment Group.
Recently, we're getting more questions about the funds, syndications, SPV, sidecar. And specifically, those are the terms that recently we're getting more questions about. And it's really for 2 reasons. Number one, a lot of the investors invest with us, they're not in finance. This isn't something they're thinking about all the time. So they're just not familiar with the vernacular. But number 2, even all the firms in our space that uses these terms, they use them differently. So even if there's an investor who does invest in private investments and in alternatives, how we refer to something may be in conflict with how a different firm refers to it. So outlining how we use, our vernacular, these terms might be a little helpful. So yeah, if we could talk through that, I think that would be of benefit to our listeners.
Funds, syndications, and sidecar.
Yeah, and SPV as well.
And
yeah.
SPV.
So Jason began, and not to retell his story because I think he's told it here already, but it was syndications. Syndications, generally what that means is you are identifying an opportunity first. After you've sourced the opportunity, you then go and source the capital to fund it. Whether that's buying a business, buying some real estate, whatever it is, it's you find the opportunity and then you turn around and go find the capital to buy it. So that's what you're doing in syndication. That's generally the process. That's in contrast to funds. And with Harris Investment Group, Jason started with just syndicating. You start small. You don't start off with funds. You start off buying individual properties one by one.
Yeah. And who can do that? Who can do a syndication?
Anyone.
Anyone
who has the risk tolerance. Anyone who has the risk tolerance to do it can do it. And that's why I think real estate, when compared to other alternative asset classes, I think it's widely considered the lowest barriers to entry. It's, everyone sees real estate, it's abundant, it's everywhere, and anyone can do it. Anyone can choose to buy a property and choose to bring on investors to buy it with them. And so we started with syndications ultimately, back in 2021, we added the fund model. So again, just to contrast and not belabor what we're talking about, syndications, you identify the opportunity, then you go find the capital. Funds, it's the other way around, generally speaking. So with a fund, you set it up, it's a blind pool. There's nothing in it. There aren't any assets to underwrite or to look into. It's just a entity. And then you start fundraising for that fund. And then over time, you start to add assets in as you can source them. So the timeline the process is just flipped. You start fundraising without having the assets, and then you find the assets along the way. So that's the big difference between syndications and funds generally. So usually they're pooled investments. There's a lot of investors that kind of come into them. SPVs, which SPV stands for special purpose vehicle. I'll highlight how we categorize it or how we talk about it, but first just the market. Like you hear SPV is in a lot of different asset classes. You hear it a lot in venture where a firm will will invest in a company, and so they will syndicate or they will seek capital from a bunch of people. They will lead out in finding the capital for the company, and all the people that invest, all the limited partners, are investing in a single thing, a single asset, a singular asset. So that's why they call it, so that special purpose vehicle is just a fancy word for just a singular asset. It's like you're putting your money into an LLC that owns an ownership stake in a company or a real estate property. Now for Harris Investment Group, we kind of convolute things a little bit. And that is where with our funds, we use the term funds when we're putting together a portfolio of like 8, 10, 12 properties. There's enough properties where there's a certain level of diversification. There's enough where it's, there's geographic diversification, there's operator diversification, different asset type diversification or sector diversification. That's a fund in our mind. And so we'll use that, usually every year we're deploying a fund. With an SPV, usually it's just one asset, like I was saying, right? But we have found, it depends on where you're at in the market in the year. Like in 2023, we didn't raise a fund, but we did do an SPV. And that SPV actually had 2 assets in it. Mm-hmm. And so we didn't want to call it a fund because it didn't have all those qualities, the diversification qualities I just referenced, right? So it would be disingenuous to call it a fund when it lacked all those things.
Gotcha.
So we use the term SPV in that case. You could call it like a mini fund because it's like not just one property, it's a couple. Mm-hmm. So usually for the Harris Investment Group, when we're buying just one property, we're syndicating it. We'll call it a syndication. When we're buying a couple properties, we'll call it an SPV. And then when we're buying a whole basket of properties, 8, 10, 12 properties, we're going to call that a fund. So that's how we do it. That's by and large how other players in our space do it. But I mean, again, going back to how other people do it, I know of real estate private equity firms who they call every single syndication where it's one property a fund.
Yeah.
So they've had 20 funds because they've bought 20 properties at separate times, and they say that they've had 20 funds. And so everyone does it differently, and that's fine. But I thought it was important just to make that distinction, at least between those 3.
Yeah.
Then there's sidecars. In sidecars, sidecar is the same as TIC. Or tenants in common.
Yeah,
it's the same thing. Common. And so some people understand what a sidecar is. Some people understand what a TIC investment is. It's the same thing as a direct investment. All those are the same. So they're all synonymous. And so we use them all, and it's kind of hard sometimes to like choose which one we're going to stick with.
That's so true.
But they all mean the same thing. And that is you are investing directly in one asset. It's a concentrated investment. You're on title on a property. So you're not in a pooled entity with a bunch of people like a fund or an SPV. You are direct on title in that property.
And that property can be a multifamily property,
Anything.
a truck stop, gas station, anything.
Anything. That's right. And so sidecars invest oftentimes a sidecar specifically. Maybe that's one distinction because they're mostly synonymous or mostly all overlap, but there's one distinction. You could invest in a syndication where you're directly on title. And all of your money is invested in one property. And that it could be a TIC investment. You can likewise do that same thing in a sidecar. The difference is, I wish there wasn't a little bit of difference, but there is. With a sidecar opportunity, generally one of the other TIC owners is a fund or an SPV or a pool entity.
It's the sidecar to the fund.
Gotcha.
Yes, that's right. So the sidecar is your individual investment, and there is a motorcycle it's attached to that is the fund, the larger investor, right? Yeah. So that is the difference. Come to think of it, it's not perfectly synonymous. There's a lot of overlap. So usually, like with our deal specifically, usually we have like 5 ownership positions that a lender will give us. Hey, you guys want to buy this gas station? Cool. There's 5 different spots on the TIC on title that can come in. So you can have 5 different owners, in which case we'll have one of the owners be a fund or an SPV. That will be a pooled entity on one of the slots. The other 4 are available to invest alongside that fund. But again, they're directly in that property only. TIC positions are valuable because it allows investors who want direct investment exposure, they can satisfy that. And also it facilitates 1031 money, which is a big part of our business, being able to come into an investment with 1031 funds, and then upon the sale, exit and go 1031 exchange into something new.
Into a different property.
And that's all possible when you have a TIC investment.
Gotcha.
And that's something that isn't possible when you're in a pooled entity with 50, 100 people, right? And so that's one important distinction between TIC and fund investments.
There's scarcity there. That's a big one that comes to mind.
So
with
when
sidecar and TIC, it's so scarce. You don't have that many.
No,
so they're very highly sought after.
That's right.
Yeah. So how do you find those?
Well, every position has them, but we have limited spots available, right?
So you pretty much have to know.
Like, so in our
investment group.
In our example, the one I just gave, where a pooled entity takes one of the 5 slots and there's 4 more, we have many hundreds of investor partners. And so we kind of keep a list of who's interested, because people will reach out and say, hey, I'm interested in a TIC investment. I got 1031 money. Let me know the next time you have an opportunity, right? So we have a short list, right? And so we could always keep our mind on that list, how much money that they're looking to place. And we, market our deals to our investor base and say, hey, we have TIC positions available. We did a campaign the other day talking about that.
Right.
And so, but yeah, there's a limited supply with every deal.
So if we have an SPV that has multiple properties in it, someone can invest with other investors into the SPV and be investing in all the properties in the SPV. Or on the sidecar, someone can invest directly into one of the properties as a TIC.
That's right.
In a TIC.
That's
awesome.
right.
Cool. Which there are advantages.
Yeah.
And maybe you could talk about those.
Yeah. High level pros and cons. When you're in a pooled entity like an SPV or fund, there's diversification.
Right.
That's the big benefit, right? All your capital isn't concentrated in one singular investment. It is spread out. It is diversified. So that's the positive. The negative, you could say, is the ability to 1031. Being able to 1031 is an enormous tax incentive that is unique to real estate. And you don't have that ability with a fund or an SPV. Now with TIC positions, the negative is that you don't have that diversification. You have a concentrated bet in a singular property.
Right.
Got it. And so you don't have the diversification benefit. There's a different level of risk because all your money is concentrated on one thing, which is why for folks who invest that way, I totally understand, because the positive is being able to 1031. It's a huge benefit. So how do you negate the negative of having that concentration? Well, you get a lot of singular bets, right? You build your own portfolio. If you can invest in the fund or the SPV that provides you that diversification, then as the investor, you got to create your own diversification through many singular bets, right? And so that's how you do it. You're effectively creating your own index.
Gotcha.
Right? It's like buying a stock. Like you could buy one equity, that's great, but it's better if you were to, if you're not going to invest in a pool, like in an index, then you create your own by buying a handful of stocks separately, and you've created your own index in a way, right? So that would be our advice for someone who likes to invest that way, which is great. Is you don't want to benefit from 1031s, but have to deal with that negative of no diversification benefits. So the key is that over time, you can't do it all at once, of course, but over time you build out a portfolio of concentrated bets, and that's how you achieve diversification.
That's awesome.
Yeah.
I love it. And I think too, the point that you bring up, like when you answered the question, how do you get access to, these types of deals? Cause it's private equity. The word private's there for a reason.
Yeah.
This isn't something on the public side of investing. And so, it's great. I love, when that marketing material got sent out and I got that text message and it showed the opportunity. It's easy. I can see exactly, oh, okay, this is a great opportunity here. This is what they're doing. And so it's nice to be able to get access, which is sometimes like the hardest.
Yeah,
when it comes to this.
And there are some barriers to entry, which I think some people have mixed opinions about. Accreditation laws and rules around being able to invest in private investments. I understand the principle behind democratizing what we're doing and making it available to everyone, but I think I tend to lean more on the safety side and the regulation side in a way. Because private investments, like with what we do with real estate, there is risk. There's absolutely risk of loss. And when retail investors have the ability to easily get exposed to that risk without the knowledge and understanding, then it can be detrimental, right? And so there's definitely a lot of problems with accreditation laws and private investments, because you can have someone who definitely qualifies because they got a lot of money, but they're not educated. And then you've got people who are totally educated, but they don't have a lot of money. Yeah. And so there's definitely problems there, but I understand the protection side of it and why our investments are private and why there is a little bit of a barrier of entry of needing to be accredited. Yeah. I think by and large it's a good thing, but there's definitely some problems there.
I agree with you. Cause look at the language that we just covered today. If you're getting into an investment opportunity and the language you don't understand, it's, oh man. It
starts to sound like gibberish.
It's like, oh, what are these? Oh, SPV, all these different words that you hear. I remember, for me, when I started getting into it, I had no idea what anything meant. And I had to just repetition, hear it over and over and over, and listen to podcasts, read books. And it's like, you have to just educate yourself a lot of the time if you're not in the field, I feel like. So, it's great having you share, about all of that.
This is one-on-one stuff, I think, but I think it's important, and it kind of demystifies some of what it is people are investing in, because ultimately what an investor partner is investing in, like at least with us, is a real asset, a piece of real estate. So all these terms, these entities, their membership interests, it's all just a lot of unneeded complication for you own a piece of a property.
Yeah, that's it.
Right? You own a piece of a property. That's what matters ultimately. And but we do complicate it sometimes, I think, unnecessarily so.
As I like to say, financy talk.
Financy talk?
We got some financy talk going on. Like well, man, Jesse, thanks so much for coming on today. Really appreciate it.
Thanks for having me.
Man, if anyone has any questions, reach out to us, contact@harrisinvestmentgroup.com, and we'll get those questions answered. And we'll do a lot more of these, 'cause I think these are, people really love getting this type of education.
Yeah, for sure. And for anybody who wants to be apprised of any deals that we have, or is curious about the whole accredited investor thing, send us an email. We are happy to answer those questions as well, and send you information if that's something that you're interested in. One last question for you, Jesse. What's your daily protein?
It's not like Jason's. It's probably around 150 to 180.
All right.
Yeah.
That's way good.
Solid.
Yeah.
How much does Jason need?
It's well over 1x.
He's on a gainer right now, right? Or is he?
I don't know, but I know he's definitely doing more than 1x's body weight in grams of protein.
So he's trying to
I'm
gain
like
a lot of
0.8
muscle.
to 1x.
Yeah. Oh wow. Okay.
Yeah.
So you guys are both on the same plan then, trying to gain.
Well, I mean, whether you're cutting or gaining, you always
Yeah.
got to have the protein. So kind of regardless, right?
That's true.
Yeah. That's very true.
Muscle support. That's
Yeah.
right. All right. That does it. That's a wrap. Jesse, thanks.
Thank you.
Always a pleasure. Bronson, hope you find your dad.
He's out there somewhere.
He's out there somewhere. I actually,
He's on an island. He's on.
is he on an island right now?
I never know. Maybe.
All right. The HIG Podcast expresses the views of its participants and may not represent the views of Harris Investment Group. The views discussed are subject to change without notice. The HIG Podcast has no duty or obligation to update the information contained herein. It should not be assumed that past investment performance discussed is an indication of future results. Wherever there is the potential for profit, there is also the potential of loss. This is the very nature of investing. The HIG Podcast and its affiliates do not provide tax, legal, or accounting advice. The information shared on this podcast should not be construed as an offering, advisory service, or investment advice. Consult your own tax, legal, and accounting advisors before engaging in any transaction. This podcast, including the information contained herein, is the sole property of Harris Investment Group and may not be copied, reproduced, republished, or posted in whole or in part without the prior written consent of Harris Investment Group.